What if everything the market is telling you right now about digital banking is completely upside down? And what if the very headlines causing retail investors to panic are actually opening up the absolute best buying opportunity of the entire year? If you've been watching the charts lately, you know the atmosphere around SoFi Technologies has turned incredibly tense. There is a massive cloud of noise floating around the financial media, specifically regarding recent headlines pointing toward an early stage investigation into potential securities law violations. The word investigation alone is usually enough to make investors hit the sell button, and we've seen the stock pull back roughly 15% since the middle of April. It is a classic market overreaction, driven by immediate fear. But when you look beneath the surface, past the aggressive headlines, the fundamental reality of this company tells a radically different story. Today, we are breaking down why this sudden drop is not a signal to run away, but rather a rare setup where the stock could realistically climb by over 50%. To understand where we are going, we first have to deconstruct the fear that is keeping the stock down right now. The recent news reports stem from an announcement that a legal firm is looking into SoFi's financial reporting methods. They are specifically questioning elements like loan accounting, fair value marks, and off balance sheet financing structures. For anyone holding the stock, seeing terms like accounting marks and securities fraud investigation can feel incredibly alarming. But we have to look at the mechanics of how these legal announcements actually work in the stock market. There is a massive fundamental difference between a potential investigation launched by a law firm and an actual proven regulatory violation. In the financial sector, firms frequently launch these exploratory inquiries whenever a stock experiences a sudden price drop, seeking to gather retail shareholders. It is a highly common pattern. Historically, the market tends to suffer from temporary amnesia when it comes to these types of headline risks. Think back to major tech giants or historical banking turnarounds. When big companies face intense legal scrutiny, congressional hearings, or public investigations, the stock price inevitably dips. Retail investors panic, institutional volume slows down, and the narrative turns completely bearish. But what happens next? The company eventually reports its next quarter of financial data. If the underlying business is structurally sound, the earnings report completely overshadows the legal noise. Suddenly, the market forgets the negative headlines because the revenue and net income figures are too strong to ignore. The share price bottoms out, builds a base, and launches upward like a rocket. The core question we have to ask ourselves right now isn't whether the headlines look scary today, but rather, is there actually something fundamentally broken inside SoFi's business operations? When you do a comprehensive deep dive into the actual corporate filings, separating the noise from the numbers, and analyze the income statement, the cash flow statement, and the balance sheet, you find absolutely no major operational red flags. The business isn't deteriorating, it's scaling. The fundamental machine that drives SoFi's revenue is operating exactly the way it is supposed to. This creates a severe disconnect between the public perception of the stock and its true intrinsic value. Because of this temporary emotional disconnect, the stock has essentially landed in the ultimate buy zone. It has become a premium asset trading at a heavy discount. In the broader equity markets, only a very small percentage of companies, typically around 15%, qualify as true on sale opportunities, where the growth trajectory remains intact, but the price tag is significantly reduced. SoFi is firmly sitting in that category right now. The market is giving you a chance to acquire a rapidly growing fintech leader at a price point that completely ignores its long term earnings power. To see exactly why a 50% upside move is firmly on the table, we have to look at the single most important metric that large institutional investors care about: earnings per share, or EPS. Wall Street institutions run on profitability. They don't just want to see a company growing its user base or increasing its top line revenue anymore. They want to see real, undeniable bottom line net income. When a company successfully transitions from losing money to generating consistent profits, and that EPS line trends upward quarter after quarter, institutional money inevitably pours in, driving the share price up along with it. If you look back at SoFi's financial history, the company reached a massive historical milestone back in December of 2023. That was the exact moment the business officially flipped the switch and became net income profitable on a GAAP basis. It wasn't a temporary blip. While there was a massive spike in profitability toward the end of 2024, followed by a natural stabilization, the overall trajectory has remained remarkably steady and consistent. Right now, the EPS numbers might show a tiny nominal fluctuation, perhaps moving down by a single penny from 14 cents to 13 cents in a given period. To an average observer, that might look like a slowdown. But a 1 cent variation is completely standard operational noise for a financial institution managing billions in loans. It is absolutely nothing to be alarmed about. When you step back, look at the big picture, and zoom out on the multi year chart, the macroeconomic trend is clear. This business is continuously becoming more profitable over time. The long term earnings power is accelerating, even while the stock price is temporarily depressed due to short term emotional trading. Beyond the steady rise in profitability, there is another massive catalyst that proves Wall Street is consistently underestimating this company: their incredible track record on the earnings calendar. If you want to find a stock that has the potential to shock the market to the upside, you look for a business that beats Wall Street's expectations quarter after quarter. SoFi has built an incredibly consistent reputation for doing exactly that. If you trace their earnings history back over the last several years, their last true earnings miss occurred all the way back in 2021. For years, every single time management has stepped up to report their quarterly data, they have beaten the consensus estimates set by analysts. This level of execution is incredibly rare for a younger financial technology company. When a business consistently outpaces expectations while simultaneously expanding its core EPS, it builds massive, unbreakable institutional confidence. Wall Street analysts are forced to repeatedly revise their price targets upward, and mutual funds and pension systems are driven to accumulate shares because the operational execution is so reliable. This is exactly why the current combination of fear driven headlines and rock solid underlying financials creates such an explosive setup. The market has driven the price down based on the mere potential of an issue, completely ignoring the fact that the actual financial engine is running cleaner and more efficiently than ever before. For anyone holding a long term view on the future of banking, this isn't a moment to panic, it's a moment of immense clarity. When you have a company that is consistently beating earnings estimates, growing its net profitability, and trading at a significant technical discount, the spring is being wound incredibly tight. The moment the company delivers its next official earnings report and proves once again that its operational growth is completely unbothered by external noise, the market narrative will shift instantly. The fear will evaporate, institutional buyers will rush back in to capture the discount, and the share price could easily surge by 50% or more to catch up to its true financial value. When you look at how traditional banks operate, they are weighed down by massive legacy costs. They have physical brick and mortar branches on every corner, aging mainframe systems from the 1980s, and immense overhead expenses that eat directly into their profit margins. SoFi, by contrast, operates on a completely digital footprint. Every single customer they onboard, every deposit they bring in, and every loan they originate passes through a highly streamlined, automated tech stack. This digital efficiency means their marginal cost to serve an additional user is drastically lower than a legacy competitor like Bank of America or Wells Fargo. As their member base expands into the tens of millions, that operating leverage shifts directly to the bottom line, accelerating their path toward massive profitability. Furthermore, we have to look closely at the genius of the SoFi ecosystem, which functions exactly like a financial flywheel. Most banks try to sell you a single product, maybe a credit card or a car loan, and then they lose touch with you. SoFi's strategy is completely different. They bring a user in through a high yield savings account or a student loan refinancing product. Once that user is inside the ecosystem, they realize how seamless the mobile application is, and they quickly adopt a second, third, or fourth product. They start investing through SoFi Webble or SoFi Invest, they open a credit card, and they eventually take out a mortgage. The cost to acquire that customer happens only once, but the lifetime value of that customer increases exponentially over time. This cross buying behavior is the secret weapon driving their revenue growth, and it is completely bulletproof against short term headline risks. We also cannot overlook the massive competitive advantage of their technology platform segment, specifically Galileo and Technisys. SoFi isn't just a consumer bank, they are literally building the AWS of fintech. Galileo provides the underlying infrastructure, API integration, and payment processing power for many of the other leading fintech companies and digital banks around the world. So even when other digital finance apps are competing for market share, they are often paying a fee to SoFi just to keep their systems running. This enterprise software business provides a highly predictable, recurring revenue stream that carries incredible profit margins. It gives SoFi a diversified B2B revenue buffer that traditional consumer lending banks simply do not possess, protecting them from macroeconomic downturns and shifting interest rate environments. Let's talk about the regulatory moat that completely changes the risk profile of this stock. A few years ago, SoFi successfully secured a national bank charter. This was a massive, historic turning point that many retail investors still don't fully appreciate. Before getting the charter, SoFi had to rely on third party partner banks to fund their loans, which meant they had to pay high fees and split their profits. Now, with a true banking charter, they can use their own customer deposits to fund their originations. When a user deposits their paycheck into a high yield SoFi checking account, SoFi can turn around and use that incredibly low cost capital to fund personal loans, student loans, and mortgages. This drastically lowers their cost of capital, widens their net interest margins, and allows them to outcompete almost every other non bank fintech platform in existence. When you piece all of these elements together, the low cost digital structure, the multi product flywheel, the enterprise software revenue from Galileo, and the immense structural advantages of their national bank charter, you start to realize just how disconnected the current stock price is from reality. Wall Street algorithms and short term traders are pricing this stock as if it's a struggling, speculative lending company facing legal ruin. But the hard data proves it is a highly resilient, deeply integrated financial technology powerhouse that is fundamentally reshaping the banking industry. The current drop in share price is a textbook gift for patient, forward thinking investors. Once the cloud of temporary legal anxiety clears away, the sheer force of SoFi's financial engine will take over, paving the way for a massive, sustained rally that could reward shareholders with massive gains.